Have you ever just stood at the bottom of some massive skyscraper, looked up and thought, what is that thing actually worth? I mean, are we talking hundreds of millions? A billion? It seems almost impossible to figure out. Well, today we're going to pull back the curtain and demystify exactly how the pros put a price tag on some of the biggest, most complex buildings in the world.
So really, how do you do it? It's not like you can just hop on Zillow and check the comps. You're dealing with this incredibly complex asset that's part architecture, part business, and part, economic engine for a whole neighborhood. The answer is pretty fascinating, because it's both a science and an art. It turns out valuation isn't just one magic formula. Professionals actually use a toolkit with 3 totally different approaches, 3 different ways of looking at the very same building to figure out what it's worth. So let's break them down. We've got the investor's lens, the neighbor's price tag, and the builder's blueprint.
Okay, let's start with the big one, the one that is absolutely crucial for commercial real estate, the income approach. This method doesn't see a pile of bricks and steel. It sees a money-making machine. The whole idea is simple. A building's value is directly tied to how much cash it can generate.
And to figure that out, we have to find the single most important number in this entire game, net operating income, or NOI. Just think of NOI as the building's pure annual profit. It's all the rent you collect, minus all the costs of running the place. Security, cleaning, utilities, the works. It's the cleanest measure of that property's earning power. Now, once an appraiser has that NOI, they can analyze it in 2 main ways. For a nice, stable, fully leased building, they'll use a pretty straightforward method called direct capitalization, and that's what we're going to walk through. But if the building's future was a bit more unpredictable, say a big renovation was planned, they'd use a much more complex forecast called a discounted cash flow. For now, though, let's stick with the most common one. This right here, this quote, is the golden rule. It really gets to the heart of the whole philosophy. You're not just buying steel and glass. You are buying a future stream of income. You are literally buying the right to collect rent checks for years and years to come. All right, let's put some simple numbers to this to see how it works. So, imagine our building, after all its operating expenses are paid, kicks out a net operating income of $500,000 a year. That's our starting point. That's the cash the building generates. Okay, next up, we need to divide that income by something called the capitalization rate, or as everyone calls it, the cap rate. Now, this cap rate is a really important number. It basically represents the annual return an investor would expect to get on a property just like this one in this specific market. A lower cap rate usually means lower risk, which means a higher value. So for our example, we'll use 6.5%. And boom! There you have it. You take the $500,000 in annual income, you divide it by that 6.5% cap rate, and you get a property value of just under $7.7 million. That's it. We just converted 1 year's profit into a total value for the entire asset. That is the power of the income approach.
All right, let's move on to the second tool in the toolkit. This one you'll get right away. The sales comparison approach is basically what we all do when we're trying to price a house. You just look at what similar properties right nearby have sold for recently. It is all about finding the comps. But, of course, for a skyscraper, finding a perfect twin is pretty much impossible. So, as you can see here, appraisers find the closest comps they can and then they make adjustments. For example, since comp 1 is in excellent condition and our building is just good, the appraiser has to adjust for that. They might knock the comp sale price down a bit to even the playing field. They do this for size, location, amenities, every little detail until they've basically figured out what that comp would have sold for if it were identical to our building. And that's how they get to an adjusted price per square foot.
Our third and final tool is the cost approach. And this one asks a totally different question. What would it cost to build this exact same property from scratch right here today? It's like you're creating a builder's blueprint and pricing out every single nail and beam. The formula itself is pretty straightforward. First, you figure out what the land is worth. Then you calculate the current cost to actually construct the building, all the materials, all the labor. But then, and this is the absolute key, you have to subtract something called depreciation. Now, depreciation isn't just about the building getting old and creaky. There are actually 3 types. Physical is what you'd think, a leaky roof, worn-out carpets. Functional obsolescence is about an outdated design, maybe a floor plan that just doesn't work for modern companies. And external obsolescence is about stuff happening outside the property, like, say, a loud factory opens up next door and makes the location way less attractive. So when would you actually use this method? Well, it's not really the go-to for your typical office building, but for brand new construction, it's essential. Or for a really unique property that doesn't generate income in a normal way, think about a school, a church, or a government building, the cost approach is often the most reliable tool you've got.
Okay, so now we have 3 different approaches, and they've probably given us 3 different numbers, right? The income approach might say $7.7 million. The sales comparison could suggest $8 million, and maybe the cost approach spits out $9 million. So what now? Well, this is where the art of appraisal comes in. It's a process called reconciliation.
An appraiser doesn't just take the average of the 3 values, no way. They weigh them based on what's most relevant, and this chart shows the whole story. For a standard income-producing property like our skyscraper, the income approach is king. As you can see, it might get, say, 80% of the weight in the final decision. Why? Because for an investor, what matters most is that cash flow. The other 2 methods are basically just a really important reality check.
And let's add one last little layer of nuance here because this is important. There's a real difference between market value and investment value. Market value is the objective, most likely price a building would sell for on the open market. But investment value, that's what a building is worth to you, a specific buyer, based on your unique strategy or your tax situation. And believe me, those 2 numbers can be very, very different.
Which brings us all the way back to the beginning. After looking at these 3 methods, you can see that in the world of commercial real estate, a building's worth is overwhelmingly tied to its ability to generate income. So the next time you look up at a skyscraper, ask yourself, is its true value really in its price tag, or is it in its paycheck?